After a decade-long period of growth and expansion in the housing market, America fell into what is known as the Great Recession. In 2007, the housing market took a tumble, dragging the financial state of America downhill. The Federal Reserve knew steps toward monetary accommodation were necessary. The goal of the United States Federal Reserve is to maintain a balanced economy. Lowering the federal funds rate, the interest rate banks charge one another, is one of many tools used to accomplish this goal. Lowering the Fed funds rate leads to decreases in the entire rate system. Interest is the price of money. When the price goes down, demand for money increases. Businesses can borrow funds to expand the market share, while consumers borrow funds to expand the economy. The excess money creates jobs and opportunities for healing. The goal is to push money back in the economy to stabilize the economic loss experienced by the recession. However, lowering the interest rates was not a miracle drug for the crippled American economy. At the end of 2007, the target federal funds rate was lowered to 4.5%. The rate decrease had little impact on the already unstable economy. America officially entered the Great Recession in 2008. With unemployment rising and the stock market falling, the Federal Reserve lowered interest rates again in September. This time, the rate was lowered to 2%. With the financial markets still looking grim and worries of deflation circling around Wall Street, the Fed took a drastic and controversial measure. On December 16, 2008, the target federal funds rate was set to a historical low between 0 and 25 basis points. This is often called the zero interest rate policy. Following the rate announcements, many banks immediately lowered their prime rates to 3.25%, making borrowing easier for the average consumer. However, borrowing money was still extremely difficult. Banks were borrowing funds for almost nothing, but many were hesitant about lending the excess money they had in their reserves.
If you had asked, not since 1984 has the Federal Reserve moved so far, so abruptly to stave off market collapse and recession. Shortly before U.S. stock trading opened on Wall Street, the U.S. Central Bank slashed a key interest rate by 0.75%. In a statement, the Fed said it took this action in view of a weakening of the economic outlook and increasing downside risks to growth.
By March 2009, the recession had hit its peak. The stock market was down by 50% and the unemployment rate was close to 10%. Individuals were panicking, and the Federal Reserve realized other monetary tools were needed to mend the fragile economy. The Fed put a forward guidance policy into place that convinced the population that interest rates would remain low until the economic conditions started to improve. Conditions still looked grim, and many thought the Federal Reserve was making a large mistake. With other quantitative measures used to improve the economy and interest rates remaining close to 0%, the economy slowly started to bounce back in 2010. But interest rates continued to stay at a record low for 7 years. Lowering interest rates may aid a hurting economy, but decreasing rates for too long can be harsh on a recovering market. Keeping rates low affects savers, who are gaining almost nothing on their funds in the money market. Investors are also driven to purchase risky financial securities to gain a higher return on their investments. This change in investing leads to a decrease in bank deposits and the ability for banks to lend out loans to consumers.
So why is jobs growth slowing down? Because GDP is slowing down. So why is GDP growth slowing down? Well, because the Federal Reserve's zero interest rate financial repression has slammed on the brakes of economic growth while temporarily boosting the value of the U.S. dollar.
The Federal Reserve is currently analyzing unemployment rates along with inflation while considering a rate hike. During a recent press conference, Janet Yellen, chairman of the Federal Reserve, stated, "When the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with its longer-run goals of maximum employment and inflation of 2%. The committee currently anticipates that even after employment and inflation are near mandate consistent levels, economy conditions may, for some time, warrant keeping the target federal funds rate below levels the committee views as normal in the long run." There is speculation that the Federal Reserve will raise the target federal funds rate in December 2015, which will hopefully allow for increased economic growth.
Though this monetary measure was effective, other tools were needed to boost the sick and failing economy. As one former Federal Reserve officer stated, "You don't want to be found dead after a shootout with unused ammunition."
The market is not functioning properly. There has been a widespread loss of confidence, and major sectors of America's financial system are at risk of shutting down.
11. The Dow plunging more than 500 points. The S&P down almost 5%. The wreckage unprecedented.
We had a sharp sell-off in stocks on Wall Street today.
Lehman bankrupt. AIG on the brink. Merrill under new ownership.
This economy is going to be a thing of beauty as we get to the other side of this economic downturn.
The bedrock of America's financial underpinnings rocked to the very core.
Quantitative easing, better known as QE, acted as that ammunition. Quantitative easing is a rather unconventional means of injecting liquid capital into the market. It is a controversial topic today, perhaps fomenting class contention. While some consider QE a war on seniors, others believe it was vital in halting the Great Recession. Roger Bootle of Capital Economics even suggests, "I suspect that in the U.S., QE and the other support programs prevented a complete disaster." So what did QE involve? QE is perceived essentially in three distinct phases. QE1 ran from November 25, 2008 to March 31, 2010. The goal? The Federal Reserve hoped to lower mortgage interest rates and increase credit availability for homeowners. This would, consequently, improve financial conditions and bolster support for the housing market. Simultaneously, the Federal Reserve purchased $1.25 trillion worth of mortgage-backed securities, $300 billion in Treasury bonds, and $175 billion in federal agency debt. This process also involved the federal takeover of mortgage corporations Fannie Mae and Freddie Mac. QE2 soon followed, running from November 3, 2010 to June 30, 2011. Again, the Federal Reserve hoped to promote economic recovery, but at a catalyzed rate. During this period of time, the Federal Reserve purchased $600 billion worth of longer-term Treasury securities. Though mortgage rates spiked a month after the start of QE2, they eventually tumbled by July 2011. QE3 ran from September 13, 2012 to December 18, 2013. This time around, the Federal Reserve hoped to hold down rates on financial instruments. There were also hopes that capital injections would encourage banks to lend, making credit more accessible to Americans. Thus, the Federal Reserve bought back additional mortgage-backed investments on a monthly basis. Though QE3 has come to an end, there's talk of QE4. As a Wall Street critic said back in August, the Fed is not going to raise rates. They're at zero forever. The Fed is not done with QE, they're just getting started. The Fed is doing QE4, QE5. This is a never-ending process. So, to summarize, what happened during the 3 rounds of QE? Well, with hopes of making credit more accessible to a larger pool of Americans, fomenting consumer spending, and driving long-term investing, the Federal Reserve purchased securities. From there, the general public turned to corporate-issued bonds, which made the market more favorable for organizations looking to expand. As Federal Reserve Officer John Williams said, "Historically, low corporate bond rates encourage businesses to start new projects and hire more workers. Though QE bolstered support for the stock market and encouraged many to invest, there is a darker side to it all. Since financial depository institutions were more willing to offer loans, moral hazard and asymmetric information often complicated matters. The International Monetary Fund even suggested that quantitative easing encouraged excessive financial risk-taking. Many Americans, mostly older citizens, also argue that the changes in monetary policy rewarded the irresponsible lender while punishing the prudent saver. Others see the changes as temporary and short-sighted. Still, it is unanimous that quantitative easing was and still is unconventional. As previously mentioned, some feel that unconventional financial times call for unconventional financial policies, and in 2001, Japanese officials shared these same sentiments. Japan is credited as the first country that started implementing QE in 2001. The Bank of England the European Central Bank, and the US soon following. The banks injected over $4.7 trillion worth of liquidity into their respective economies, increasing GDP by between 1 and 3%. Of course, high expectations across the globe were not met, especially on a microeconomic level. In America, net private non-residential investment fell by 80% as a percentage of GDP between 2007 and 2009. Investment in Europe also followed suit. So, was QE effective? It is inherently subjective. There are a myriad of positive and negative economic, political, and social implications to quantitative easing. Some argue that boosted asset prices only help the rich while hurting the elderly. Others argue that only the Federal Reserve benefited, since it quickly became easier to finance deficits. Others even argue that QE was a personal attack on small and medium businesses. Nevertheless, as Ray Dalio, Chairman and Chief Investment Officer of Bridgewater Associates, said, forceful QE and forceful structural reforms, including currency adjustment, are what is needed.
Are beginning to rise again. So America's coming back. We've risen from recession. We have the capacity to write our own future. Better position than any other nation on earth.